So let's have a look at building societies and credit unions now. With building societies, they are authorised deposit-taking institutions, so they can accept deposits from customers like banks, and they mainly lend for property. Now, during regulation of banks, building societies grew. However, since deregulation, the share of assets has shrunk significantly, and in response to this, building societies have had to merge to rationalise their costs. Some of them have become banks. They've improved their technology to provide a better service and be more efficient in their costs. And they've diversified their activities and products that they offer to savers and borrowers. So building societies now provide a lot of the services that a commercial bank would provide. Where do they get their money from? Well, as authorised deposit-taking institutions, mainly deposits from customers, and then, as we said before, finance to borrowers, mainly for property. But they also provide loans and credit cards. As I said before, they provide a lot of the services that a normal commercial bank would provide. Because they are authorised deposit-taking institutions, APRA is their regulator, and they have the same prudential and reporting standards. Newcastle Permanent is an excellent example of a building society. Like commercial banks, they offer a whole host of financial services. However, they are a mutual. So by being a mutual, Newcastle Permanent is owned by customers as opposed to banks, which are typically owned by shareholders. And this allows Newcastle Permanent to provide an alternative to traditional banks, but with a different ownership model where Newcastle Permanent is owned by customers. Newcastle Permanent is also Australia's largest building society. With credit unions, there is a common bond of association. So that bond of association might be due to employment, industry or community. So for example, the Shell Employees Credit Union is for Shell employees. So their bond of association is through their employment. They are authorised deposit-taking institutions, so they can accept deposits from their members or customers. Where do they get their money from? Well, as I said before, they're authorised deposit-taking institutions, so they get their money from members, as well as other credit unions, as well as the issuing of securities. What do they do with their money? Similar to a bank, they provide finance to their members, so housing loans, personal loans and credit cards, as well as some commercial lending. And as an authorised deposit-taking institution, they're regulated by APRA with the same prudential and reporting standards. So in essence, what did we cover this topic? In this topic, we learned about non-bank financial institutions. We learned investment and merchant banks provide advisory services, managed funds pool savings together and then invest those savings into different asset classes. Superannuation funds through employer contributions help individuals save for retirement. Life and general insurance companies accept premiums from customers and then protect those customers against different risks. We discussed hedge funds, which have a different structure to the traditional unit trust, where hedge funds use a much more flexible and sophisticated investment strategy to try and chase above average returns. We talked about finance companies, where finance companies are not authorised deposit-taking institutions, so they issue securities into financial markets and then lend to individuals and business. And we also talked about building societies and credit unions who are authorised deposit-taking institutions, so they receive deposits from their members or customers and then lend mainly for housing, but they also provide other financial services such as credit cards, for example.